Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is Building Your Sustainable Portfolio. So welcome to this session. My name is Shen Chu. I'm the moderator for this webinar. So today, we're going to talk about how do we build a personal portfolio that is sustainable. So before we begin, as usual, disclaimer, whatever is said in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today. Our speaker is none other than Mr. Max Tan. So Max first indulged himself in the SME financing industry after finishing his diploma in finance and investment in TAUC. He was the former risk and compliance officer with Rakuten Trade and also a dealer representative with TA Securities. To date, Matt has just passed the 7 years mark in the capital market as an investor himself, where he also had the opportunity to run the financial blog One to Invest with over 60,000 followers since 2019. So Max has hosted close to 50 interviews with publicly listed companies in Bursa Malaysia, as well as NASDAQ, and has been featured on Xinqiu, Nanyang, China Press, City Plus FM, Caijing. Currently, Max is also an SGX Academy speaker. So good to have you here today. Max, how are you?
Hi, Shane. And hi, everyone. Good evening. Thank you, Shane, for the kind introduction. So I'm doing good and hope you guys are doing well too. And a bit of I wouldn't say congratulations, but have a great long weekend ahead after the session. So yeah,
all right.
I think quite surprisingly we have a long weekend, following us quite closely after our previous long weekend. But I'm sure everyone here would enjoy a good long weekend soon.
All right, go ahead and share your screen. We can't wait to learn from you.
Right. So yep. Okay. Once again, thank you everyone for joining tonight, and thank you, Shane, for the kind introduction. So our topic today will be building your very own sustainable portfolio. And we hope that throughout the session, you can understand how to decode so-called portfolio management. It's not something that is overly complex. And once you understand how to structure from A to Z, then you can build your very own sustainable portfolio. This is not rocket science. It's not something that you need to calculate the beta and everything, but just something that tailor-made to yourself, right? So today's session, we will focus on building up your sustainable portfolio, obviously, and I think it's a relatively simple but yet important subject to securing your very own financial future. So hopefully after the session, you'll be able to decode your own methods of managing your portfolio. There's no fixed method, there's no right or wrong in this, and be able to generate a sustained income throughout the journey going forward, right? So let's go into it now. But again, a very quick disclaimer, by no means that our platform are licensed to provide any form of investment or financial advice, and all information provided today is just for educational or sharing purpose only. And if we do mention any stocks or any indices or any type of securities, I'm not a licensed person to give you the financial advice, and we do not solicit any form of buy, sell, or hold recommendation at all, right? So I think introduction, Shane has done a good job of talking a bit about myself, so I'm going to skip this part and jump straight into our topic today. Now, please allow me to explain a bit more what do we mean by a sustainable portfolio. When we talk about think of it, why do we actually go to work every day? Why do you wake up? And some of us, we hate waking up in the early morning, 7 a.m., 6 a.m., even some. And why do you want to wake up and go to work? And to save and invest your hard-earned money. So I believe everyone, unless you're really passionate about something, then obviously it's on a different case. But many of us, we have a ulterior motive as to why do we go to work and also save and invest the money, right? So if you do not have a ulterior motive, or you do not have a ultimate game plan in mind, then you're just like a car driving on the highway, but you don't know where to go because you have no end goals in mind. So each of us, like the car, we have a different destination to go. and each of us, we just have a different kinds of goals in mind. Some of us, we might want to retire and chill, surrounded by lush, and some of us might want to have a beach house for retirement, and some of us, maybe some of us, we like a lavish lifestyle, like traveling around the world in luxurious style, having a private jet, having a private private yacht. There's no right or wrong, once again. So it's important to actually figure out what you really want to do in life, right? So humans being humans, I think no one enjoys being forced to do something they like, right? Just like me, I always enjoy sharing whatever knowledge or experience I have with others, but I guess you guys can tell by how terrible I am at visualizing things that I want to share. Later on, you will have a first experience of it at my slides. But I want to emphasize at the point being that we really want to do something we want in life, but not being forced to do it. That is what we call a freedom. And to achieve freedom, obviously you need some form of income to support you, which is passive income. So when we talk about freedom, it's not really per se that we do completely nothing in life, like just lying down and do completely nothing, but to have the freedom to actually choose what kind of things that you want to do in life. So like myself, and I'm still working very hard to achieve this kind of dream life. And if you haven't gone through the concept of active income and also passive income, I strongly urge you to go through the book called Rich Dad Poor Dad. It really helps you a lot. And for achieving that kind of passive income, it's really important that you have a sustainable portfolio that supports your lifestyle, which we will dive a bit deeper in shortly, right? Now, let me use a bit of time to explain what do we mean by active income and also passive income. So some of you might already know, but bear with me for some who, for the benefit of those who do not know what that means. Basically, active income is that you are actively exchanging your time in exchange for money. This is what I would call an active income. But to build a sustainable portfolio, that would mean that you are building income or you're generating income without selling your time for money. So the portfolio itself, your investment portfolio, it will generate you sufficient support to support your dream lifestyle, right? Don't worry, today's session is not a motivational session, which I will ask you to do a lot of different kinds of things, but just a more solid session on how to, from the ground, if I have this kind of lifestyle, how do I start, where do I start, and what kind of things that I can buy in the market to build my very own portfolio. And I think on a very realistic ground, we should first start by setting a more realistic goal, at least at the beginning level, so you don't get discouraged as you progress. For example, if you tell me that, Max, I'm currently a salaryman, I'm earning around 5,000 to 6,000 per month, but I have a dream car of Lamborghini and I want it in the next 3 years. I wouldn't deny that it would be impossible, but to be honest, it will be incredibly hard. And imagine that if you work towards that goal 2 years down the road, and ultimately you look back and you notice that, okay, I'm not going to hit that goal because it's not that realistic based on the actionable plans that you have set up, and you would waste your effort, you waste your energy, and you waste the whole starting point of the journey, right? But I think generally speaking, whatever dreams that you have, as long as you have a solid actionable plan to it, I think they're still achievable as long as the timeline still makes sense. So as you mentioned earlier, like things like private jet, which, to be honest, I think it's someone that everyone wants to experience once in life, and probably a beach house, and probably a private mansion and things like that. So I think the first critical step is to figure out exactly how much you need in order to sustain your dream lifestyle. So for a lot of people, for starter, you may need 3,000 per month passively. Imagine how would a 3,000 change your life if it comes into your pocket passively. That means that if you choose not to work today, every month you will still receive 3,000 into your pocket passively. So I believe 3,000 is sufficient to change the lifestyle of a lot of people, let alone if you are able to build a very strong portfolio that generates a cash flow that is far higher than that. Now, but frankly speaking, in Malaysia, I think 3,000 is not sufficient to support family, even though you're debt free because of obvious reasons like inflation and all. And some might even cost 5,000, 7,000, and maybe 10,000. But I want to emphasize that today's session is not a competition. It's not like, oh, my dream is more grand than yours. My passive income requirements is higher than yours. But it depends on you sitting down after the session to really think about what do you really want in life, what kind of lifestyle do you want, and what are the first actionable steps that you can actually take after the session today. So you can really think about what are the things that you truly need in your life, right? So maybe go a bit into a very quick case study that it's more on the realistic ground, and I think it will be fun to actually do a reverse calculation based on a realistic view to calculate. Now, when we mentioned the numbers just now, 10,000, maybe 20,000 per month is a bit far-fetched. And if I'm being honest, if you retire in Kuala Lumpur, or maybe in my case, hometown, which is situated in Perak, I think 5,000 is a pretty comfortable number to live with if you're debt free and you're not supporting the whole family. But again, it depends on your life, what kind of lifestyle you are looking at. Again, you keep seeing me emphasizing on what kind of lifestyle you really want, because I want you to set sight on that goal and do not waver from it. You don't set sight from a goal and you started to waver along the way, which you would lose focus, and ultimately you might not able to achieve. Because I will share with you the numbers later on as to why you need to set a goal now and not to waver along the way. Because once you miscalculate along the way, you might suffer not supporting your lifestyle. So let's say if you need 5,000 per month to live your dream lifestyle debt free, right? So we are expecting a 60,000, which is 5,000 times 12 months. We're expecting a 60,000 per year, and your passive annual passive income requirement will be the said 60,000. Now, do a very quick survey here. What is the average rate of return you expect from the market currently, right? You can comment in the Q&A or chat box below. What do you think is the average rate of return on FD, some of the investment available in the market? Of course, if anyone comments, 10-20% per month, sorry, that one is MLM level, it's completely out of the game. We'll talk about it later on. But generally, what do you guys think about the average return that we can hit realistically in Malaysia? So maybe a bit of time for you guys to actually comment in the comment box. While we are waiting, actually the rate of return in Malaysia is not that bad, by the way. According to our website, it's all I've seen more comments coming in. So let me see. So 12% per annum, I think 3 to 5%, 3% and 3%. I think those are very accurate numbers, very quite close. According to our website, Ringgit Plus, we actually have FD that offers you 4% plus and all the way close to 6%. But obviously, 6% is not on an annualized basis. They have certain terms and conditions that would, like the 6% only apply for the first 6 months, then subsequently 6 months, you only entitled for 3%. But you get the idea of it. In Malaysia, generally, we can look for things like 4% to maybe 5%, right? So in our case, maybe we take a 5% as a median or average return for the case study purpose. Now, I think in Malaysia, let's talk a bit about the inflation issue. Before actually discounting inflation, I think your portfolio needs to generate at least 5% in cash flow for you to sustain your lifestyle, or have 5% capital appreciation, so you can sell the additional 5%, cash out, and to support your lifestyle. I don't think that you guys would agree with me if the actual inflation rate is somewhat lower than 5%. Now, I think if you do a reverse calculation, let's say we take a 5% average return that you could get from the market, you can take out your calculator. We were talking about 5,000 per month, 60,000 per annum. So if you take a 5% reverse calculation, you will need an initial capital of 1.2 million. Now, if you are just purely working and saving, 1.2 million is a ridiculously high number. This is why you need to invest to grow your portfolio along the way, which we will talk a bit more later on. And of course, realistically speaking, apart from the cash flow part that you need to generate, I think you need a minimum of 10% per annum to make sure that your money, okay, maybe you need to make a 5% at least per year to make sure that your money do not depreciate against inflation. But if you want to cash out for the investment or to acquire dividend from your investment, I think generally speaking, you will need a 10%. Basically, it's a 5% plus 5% return on every year to create a sustainable portfolio. Now, which I would say that if you look at the past 10 years performance of some of the mutual funds or unit trusts in Malaysia, 10% is not exactly easy. But this is because the fund managers, they have fund mandates, they have their things to adhere to. So we being individual level, we are more flexible in a sense, and we can always adjust the portfolio to our liking and also to our own very own risk appetite. Okay, so now once we understand that how much of a capital we need in order to generate the amount of passive income we need, now we need to understand another aspect of setting your goal, and also before you start building your own portfolio, which is your risk profile. Now, generally speaking, if you have gone to any financial advisor, if you have gone to any financial expert, or you've gone to any consultant, they will ask you to have a 6 months worth of saving. That means that if you spend around 8,000, 7,000, 8,000 now inclusive of your debts per month, then I would recommend you have a savings of 6 months just in case anything happens, like COVID, touch wood, but if it happens, it happens. So it's best to have a minimum of 6 month kind of saving in your bank account. Try not to always utilize them for investment, because this is really your saving grace whenever things go haywire. So that is the first thing I would recommend to people. When you set your goal, you have a 6 months worth of saving before you start investing. Now, going into the next step is very critical. I'll share with you a bit more why is it so hypercritical. Only invest the money you can afford to lose. If you do not do that, there will be a lot of problem that comes. Okay. Obviously, the first reason being that all kind of investment, no matter what kind of investment, there is no such thing called safe risk-free. Someone telling you risk-free, please run away. Most likely than not, it's a scam. The only so-called quote-unquote risk-free is the your FD in the bank, but it's only capped at 250,000 by PADM. Anything more than that, probably you will need to bear your own risk. Okay, that is the first factor. And second factor is the mentality you have. If you invest the money that you cannot afford to lose into any form of investment, right? You know that in the next 1 or 2 years, you're gonna spend this amount of money on whatever it is, be it your marriage, be it your I wouldn't say vacation is a must, but probably your children's education, or maybe you want to buy your dream house, you have down payment for your dream house. If you're gonna spend the money anytime soon and you cannot afford to lose it, then be really careful to it. Think of this. If you have a 50,000 on hand, you are tempted to deploy the capital, obviously, but you know that anytime soon you might need the money for your children's college. Then after you put into a certain investment, let's say a stock, be it a Malaysia stock, or maybe let's talk something a bit hotter, let's say the US tech space, you invested in Tesla. Now today's Tesla price you invest into is $250 per share, and the moment it starts dropping, you will start panicking. All the plans that you set up, your entry plan, exit plan, your fundamental analysis, technical analysis, it will be gone. Because you start panicking if you could recover the money to support the things that you wanted to do initially. That's for sure, I can tell you. It will immediately, first thing, it will impact your mood. I don't know whether it will impact your day-to-day living, but it certainly will impact your mood overall. You will keep looking at your phone. What is the price now? What's the price now? I cannot afford to lose this. And the moment you have that mentality that I cannot lose this money, your decision making will go wrong. It definitely would impact your decision making process, and you couldn't make any sound investment sound investment decision when you have that kind of mentality. You're trying to be risk adverse when your original plan might not be it. So based on my personal experience in the capital market, and also I have an opportunity to talk to some of the very seasoned investors, they do agree with that. Mentality towards investment is exceptionally critical, probably more important than your investment or analysis kind of skill sets. So be very, very careful on investing the money, whether you can afford to lose or you cannot afford to lose. So how do you define that? Make sure that if you really lose the whole sum of money, it will not impact your day-to-day lifestyle. That's how I would define whether you can lose the money or you cannot lose the money, right? So let's talk a bit deeper about this risk element. Now, we are talking about how much money you can actually afford to lose, right? For example, if you invest 10,000, there's also an aspect to that of how much can you afford to lose before your decision-making process goes a bit blurry. So for example, if you invested 10,000, then if it goes to 5,000, you start to panic, you start to think about selling the shares and everything, or selling your investment and everything, then you know that at the 50% point, that is your maximum risk tolerance level. Hit that point, sell immediately, cut your losses, and convert it back into cash. Make sure you have this kind of a mentality prepared before you go into what we would call the war, right? Which is the field of investment. And I think apart from understanding how much you can lose and how much risk you can actually take in, the other aspect of risk that I don't think a lot of people talk about it, I think it's a bit underrated, is how well you understand your own investment. So the rule of thumb is that the more you understand your investment, the easier for you to control that investment, right? If you do not, let me give you an example. Let's say we talk about stock. I'm sure everyone here at least heard about what is stock or exposed to stock market before. Now imagine someone of very close to you come to tell you about ABC Berhad. So ABC Berhad, he told you this is an insider news. This is something gonna be fantastic in the next week. It will go up tremendously. Now, if you experience the stock market, probably that will be true. But your entry, maybe your entry price is same as your friend or so your close associate that told you about the news. But how do you know when to exit if you do not understand the investment? You might argue that, oh, I asked him or I asked her. But what if at the point of time, they are busy to answer your phone? So you have seen a lot of stock chart that they went up and then they crashed down. The moment it crashed down, are you able to exit? Most likely than not, you can't, because you do not understand that investment initially. And obviously, you cannot time your investment based on it. And also, being a Malaysian myself, and you guys, I understand that there is a lot of quote unquote investment opportunities out there that always came across us. So how do you filter them? Number one, always my number one rule, make sure that they are regulated products. So what do I mean by regulated products? That means that they are legal, not something that promises you 10% return per month, or some even per day. They can say whatever they want to scam you. This kind of investment, you make sure to move away from it, because this kind of investment are the investment that can actually lose you money, lose 100% of your money. You can get nothing back. Even though we're talking about the stock market crash, fine, the market crashes. So you lose 30-40% of your money. You still have 60% left. But if you buying into unregulated products, chances are you wouldn't get any single percent back on your investment, right? And again, when you are listening to someone, make sure that you understand the investment enough before you make any kind of investment decision. I mentioned about the potential loss, which is at the crashing point, right? A lot of people take profit, but it's also important to mention that if you are trying to time it too earlier, you might lose out on the opportunity cost if you do not understand the investment itself. So understand the risk aspect. It also comes in two forms. The first one being that understand your risk appetite, how much money you can afford to lose, and how well do you understand an investment. right? So maybe we have a very quick look on, we talked about the risk management just now. And let's talk a bit about the types of assets that we can invest in Malaysia, right? So we have bonds, we have stocks, ETF, and something more interesting that we will discuss today is should you as an investor put ECF into your portfolio, and how does warrant work? And if time allows, I will explain a bit in depth about warrant, because when I first started investing in the stock market, the first instrument that I bought is warrant, right? So let's get into the bond, which is IOU. People from finance industry, they know what does bond mean, but for the benefit of those who do not, let's go into bond first as the first type of things that you can consider apart from FD alone. Now, okay, bond, as you can see, IOU just now, is effectively a loan that you give to the issuer of the bond, right? So issuer can be the government, maybe a company, a MNC, whatever it is. When you buy a bond, you are effectively lending the money to the issuer. So and then the issuer is the one that issues the bond in exchange for your money. So when you buy a bond, you are going to expect if you're talking of, we are not going to talk into something technical like no coupon bond, but generally speaking, general bonds, you are going to get what we call coupon. It means interest. So it's like you put money in FD, you lend money to the bank for the bank to lend the money to others. So it's the same case. You lend money to the company. Let's say for Malaysia government, you lend money to the government that wants to build a new highway. Then they need more money than they have in the budget. So they might issue bond to us investors to raise the money. And then let's say the government says, okay, since you lend me this amount of money, there is always no such thing as free capital in the market. So I'll pay you an interest of 5%. So imagine if you buy a 10-year bond worth of 1,000, for example, you'll receive a 50 ringgit in what we call coupon or interest effectively. Then by the end of 10 years, you will get your 1,000 ringgit back. Okay. A lot of bonds, there are a lot of types of bonds in the market, like no coupon bond, which they might sell you at a discount now. For example, they sell you the bond at maybe 900 ringgit. But after 10 years, you can sell it back to them at 1,000. So your expected rate of return is around 10%. But if you think about it, 10 years down the road, you only get a 10%. Obviously, you're going to lose out bad because of inflation. The buying power is simply not the same after that, right? And in Malaysia, I think investing in bonds can actually provide you a quite regular income stream in terms of the interest payment. And generally speaking, bonds they're less riskier than investing in stocks. But at the same time, risk and reward, being risk and reward, you might receive a lower potential return. Okay. And in Malaysia, how do you buy into bonds? This might be the question that you guys have. Unfortunately, correct me if I'm wrong, but bonds in Malaysia, the entry level, it's actually quite high. The minimum entry level for bonds is quite high. The alternative channel, the easiest channel you can get access to bond, it will be mutual fund or unit trust. These are the terms that different depending on the house itself. But unit trust or mutual fund, effectively, it's actually a pool of securities. What do I mean by securities is that let's say the mutual fund itself is called bond fund A. It has 10 bonds from the government, maybe in different time frame, 2-year payback period, 5-year payback period, and 10-year payback period, and probably have some other bonds from people like TNB and maybe some MNC kind of companies. So obviously, mutual fund, once they pool the amount of money, they can always try to diversify their portfolio not only into bonds, but that again depends on the mandate of it, right? So if you're interested in bond, how do you start? So you can open an investment account with any of the mutual fund house, and then you can decide how much you want to invest, and you can choose a bond-focused mutual fund or unit trust that suits your investment goal and risk tolerance. After you sit down, and then you have a very good thinking about what do I really want in life. So how much do I need if I want to support that kind of lifestyle? So what kind of instrument do I want to start with? bond is one of the easier instrument that we will say for beginners, right? So that would be on bond. But again, all kinds of investment carry risk. Bond do carry risk as well. Let me give you an example of an oil and gas company. I don't want to mention the name, but I'm sure you guys are aware. The bond price did crash from 100 to a lowest point of a single digit before. So make sure that when you're buying a bond, you don't only look at the yield, which means interest rate. Another analogy is that today a sketchy bank come out and they tell you we are offering 10% interest rate per month if you put in our FD. But when you check the background of that sketchy bank, nothing comes up. So you know it was wrong. But 10% FD, still sound very attractive. So be careful of these kind of things. And these kind of things in bond, we will call them junk bonds. This is why they offer that you such a high interest rate, because they might default on your payment. Default means that they couldn't pay you back the payment. So what's the point of you earning at 10%, but you lose 100% of the money? Your net loss is still 10%, right? So be really careful on that. And again, if you want to start with bonds, mutual fund, unit trust is a good avenue. Now, my personal favorite, if you guys been to my webinar or you've seen me before, personal favorite is always stocks. But again, since we are a more for the benefit of those who do know, basically stocks or shares or equities, they represent the ownership of company. It's not something that you log into your broker account and then you look at the price jumping up and down. It's not something that simple. It's actually the ownership or the shareholding of a company. So whenever you buy a share, you are actually buying a very small piece of, I don't know if you guys are wealthy, you're probably buying a big portion of the company. But us as a minority shareholder, we are buying a very small piece of company, and you would reposition yourself to become a shareholder. And obviously, as a shareholder, you will be entitled to quite some benefits of being a shareholder. So, for example, if the company managed to make profit and they are having a very good cash flow, they could enjoy a dividend payout. And on AGM or EGM level, you can actually have the right to vote against or vote for the company's resolutions. And obviously, if you have 10, I think around 15% of the shares, you can always call for EGM of a PLC, and then you can call them out and tell them, I want an EGM, I want to remove blah blah blah, or I want to incorporate a new business into it. So that depends on what kind of results that you want. Okay. And how do stocks actually work? So in the stock market, imagine that you buy 100 shares of company A and they have 1,000 shares outstanding. And if you own 10% of the company, then obviously you will be entitled to 10% of the company's profit. So you will receive the dividend in proportionate to your share. Obviously, if the company is growing, for example, companies like, again, Tesla, let's say Tesla is continuously delivering good results, good number of vehicles, good revenue, good profit, then people will have a better expectation onto the company's future performance. Then they'll buy into the share. Now, the stock market over the short term and medium term is always a function of supply and demand. Whenever there's an increase in terms of demand, the share price will rise. So you as an investor, if you are invested into that company and the financial performance of it is improving, so you could also earn a capital appreciation from it. But vice versa, obviously, if the company, unfortunately, it doesn't perform, then you also lose out. The share price would decline. It happens very normally. Even that only just some rumors that came out, it would actually depreciate the valuation of your shares, right? So this is why I mentioned that it's quite risky or more volatile compared to the bonds, which are more stable. Imagine you're buying a Malaysian government bond. So the occasion of Malaysian having a big issue internationally or the potential of default is quite low. So frankly speaking, if we are staying in Malaysia go bankrupt, we are also in big trouble as well, right? And for beginners, how can I start buying stocks if I really like the company? For example, I like Nestle, I like let's say Skyworth, I like let's say some technology companies. So how do I get started? So if you want to invest in shares in Malaysia, the first thing you should do is always open a CDS account, Central Depository System account. So you have that account. It's like a platform for you to hold your shares. And subsequently, you can look for the right stock to buy. This is the trickiest part in selecting stocks to buy. Now, depends on your investment strategy. You can focus on high growth stocks. You can focus on dividend play stocks. You can focus on defensive stock. You can focus on cyclical. It all depends on how well do you understand the industry itself, right? So once you have an account, you are ready, you know what stock you're going to buy, you can place an order. And subsequently, what you need to do is continuously monitor your investment. So a lot of people, they think that passive investing or passive income is that, okay, today I buy this company. Once I done the homework, I can stop indefinitely. I wish things were so simple, but you have to continuously monitor the changes on the company, whether it's on external level, which means that, for example, you are buying a plantation company, let's say oil pump company, due to competition for another country, oil pump prices, CPO prices actually crash. And what do you think would happen to the share price of that company? So obviously it would crash as well. These are external factors that you need to monitor. You do not need to be hardcore, to actually spend 1 or 2 hours researching per day, although that's what I like to do. But 5 minutes to 10 minutes or maybe half an hour at best is sufficient enough to catch up to the company, to understand a bit more what happened. And obviously after you buying the share, the next step would be once you're ready, you can sell your shares and also to take the profit from it, right? Just to share a little bit more, probably you guys can tell, because of my age and risk profile, personally, I would prefer stock more. It's more attractive to me on a risk and reward ratio basis. But at the same time, as I mentioned just now, there are also inherent risks associated with stocks. Let me give you an example. I'm sure everyone here has experienced the glove mania, which is no one can expect why or when the share price of glove companies will go down back then. No one can predict the exact timing of the crash of the glove stocks. So yes, it can be extremely volatile, but there are also, due to the volatility, there are also a lot of interesting investment opportunities that are available in Malaysia. And we were talking about FD rates, which is 4 to 6%. But do you know, again, no buy, sell, or call hold recommendation. Maybank currently it gives you around 6.64 dividend yield. So based on today's closing price of 8.73 ringgit, which is higher than bank FD. So imagine if you're saving in Maybank that gives you a 4% interest rate per month. Why not become a shareholder of Maybank and then earn a 6-point-something% dividend yield? So that once you have the mindset changes, and if you compound it, the small changes along the way, you'll see significant changes in structuring your portfolio and overall long-term performance, right? And in the industry, there's always a joke that if you buy into Maybank and Maybank someday collapse, I think Malaysia is not far from it. So there are a lot of companies that are quite, I wouldn't say safe, but generally their risks are lower as compared to others, right? So this is the exchange traded fund, ETF. ETF is also quite a hot financial instrument for investor to invest into due to the simplicity of it. Now, imagine that you are a very busy person, you have to work on daytime, and then nighttime you have family to take care of. So where does the time to squeeze and actually look for investment opportunities, especially on bonds or maybe on stocks? So don't worry about that. You can have a professional fund manager professional fund manager for them to design an ETF that tracks a certain portfolio of stocks. It's very passive, that the fund manager do not need to do a lot of things. Otherwise, it wouldn't be ETF anymore. So basically, ETF, it tracks the performance of a stocks, of a pool of bonds, a pool of commodities. They are designed to track the performance of these things that I mentioned just now. It's not designed to outperform them. If they're designed to track. So for example, if a couple of months back then, we see a big turmoil in terms of share price for technology company, not only in US, but across the world. But you do not know which technology to choose. Although the price is quite attractive, but you do not know which company to choose. This is where ETF comes into place. There are a lot of ETFs that are available that you can actually leverage on them to save your time of investing, because they already choose a basket of stocks for you or basket of securities for you to go straight into it. So let me give you an example. If there's an ETF with regards to our national index FBM-KLCI, so if you buy shares in the ETF, effectively you are also buying a fraction of the 30 companies in one go. So if any of the company in the FBM-KLCI goes up in value, or 30 of them goes up together, then the ETF, the value of it will also increase. But vice versa, if the index or the underlying asset goes down, your profit obviously will also, you will also suffer losses on ETF level, right? To be honest, I'm a huge fan of actually supporting local companies. I always love to invest in local companies because, if you don't support them, then who will? But frankly speaking, the alternative choices of ETF is just too much in overseas. And although, and we are seeing ringgit is being depreciating 4.6 something now, although it's being one of the strategies for us to maintain the competitiveness of our exports, but it still doesn't deny the fact that if you invest, there are a lot of interesting opportunities that we can have in an overseas market. So let me give you an example, some of the reasons why you should really consider overseas ETF if you're serious into building it into a portfolio. Number one, you get exposure to the foreign shares. Now, with M Plus Global and also obviously Mumu platform like this, it's getting easier to get exposure into the foreign shares. But if you do not want, then you can go through ETF. You do not have to do the stock pick yourself, but you can get exposure to the companies that are overseas. And secondly, although I mentioned that ringgit ultimately helps in our export, but us, we are a consumer. So it doesn't mean that ringgit depreciate, it must be good for me. It might not. So a smart investor, you might want to, sort of diversify your foreign currency holdings in your portfolio. Maybe some into Sing, maybe some into USD, right? So I try to diversify your kind of securities into different or I would say foreign currencies, right? And interestingly, in Bursa Malaysia, we also have a lot of creative products on the ETF level. So let me explain a bit more. We have leverage ETF. We also have inverse ETF. So leverage ETF is quite simple. Let's say 2 times FBM-KLCI. If FBM-KLCI move up by 1 times, then the 2 times FBM-KLCI will move up by 2 points. 2 points. So it's a leverage effect of the ETF itself. Then if you're talking about inverse, as the name suggests, you might already know, if take FBM-KLCI for again, this time we take -1 FBM-KLCI. If FBM-KLCI go up by 1 point, the ETF will go down by 1 point because it's inverse relationship. So you guys are betting against each other. There's no right or wrong, but just sharing with you, there are these kind of tools and investment that are available in the market, right? Now, the next one, ECF, equity crowdfunding. I think now ECF is becoming more and more common, and you see a lot of advertisement that ask you to invest into ECF. This is why I also incorporated ECF into building a sustainable portfolio. Is it viable or is it not viable? So let me first explain what ECF actually is. So ECF is actually an approach for a lot of companies to raise fund by selling a small amount of equity that they have to a large number of investors, because they are not like publicly listed companies that there are platforms ready that by a click of your fingertip, you can invest into them. So startups or smaller businesses, imagine how are they going to prove that you are a shareholder for their company? So the things get more complex, and it also is not cost effective if they were to put their company names in Bursa. That would segregate the listed status of some of the companies, right? And a lot of startups, and especially after COVID, a lot of people, they actually start their own kind of journey, start their own business. So these companies, they might have difficulty in raising funds. Their plans might be good. the execution might be good, the founder team might be good, but they just have a difficulty in raising funds. So ECF is one of the fantastic avenue for them to go and raise funds. Okay, so let me give you an example. You are interested in a restaurant industry for a very long time. Now, a company B, let's call company B, is interested opening a so-called restaurant in the town. So you, as the ECF investor, you can actually go as low as a couple of hundred ringgit. I've seen it, couple of hundred ringgit, you can own the shares of a private company that's in the industry that you like. Because even though we have close to, I think we have 900 something plus companies listed on Bursa Malaysia, they might not be the companies that you are interested or you wanted to invest to, right? So effectively, ECF, like the name suggests, equity crowdfunding, it's raising funds from the public, but in a one much smaller juncture, maybe a couple of hundred ringgit, right? So how do you invest into ECF then? So you choose a platform, again, only choose regulated platform, or you might risk losing all your money you put into it. And obviously create an account and start funding the account. Let's say put in 1,000, put in 2,000, and you start to shop for businesses. Now the difference between ECF and also stock trading is stock trading, we have too many companies. So it looks like a trading platform that you buy this number, you're hoping for the number to go up later on. So there are things like that. But ECF is more holistic view. You can actually have a click and then you can see the business, what are we doing, and then why do you want the money for, things like that. So you can choose the business you want to invest to, then you can do a review. And if you decided that this is a good investment, you can invest into it. And of course, you still need to monitor your investment. Now, here comes the problem. Equity crowdfunding, it sounds good for the private company owner, and for us as investor, we can join into some of the companies that are not usually available. Now, the critical question is, how do you exit? How do you sell the shares of ECF? The quick answer to you is, we might have an exchange coming up, not from me, I mean from the ECF platform owners. We might have an exchange coming up, but no one knows how fast it would be yet. And ECF is not like shares. You do not have a very stringent, bid and ask. The spread is small, but spread could be huge. Spread could be huge. And in Malaysia itself, there are very limited cases where ECF exit are successful. So the mentality you have, again, our topic today is building a sustainable portfolio, and ECF is obviously on the higher risk kind of aspect of it. If you want to risk your capital, but probably not that big portion of your investment should be put into it. So my mentality, I do invest in a couple of ECF, and I also involved in a bit of pre-IPO kind of stuff. But the mentality I would have when I invest in a ECF, or would expect I get nothing from it. The company might not be able to, pay me back the money. In technical term, we call redeem my RCPS shares by the end of it. So the mentality of you buying into ECF is sort of like go big or go big or go home, because the exit cases in Malaysia is simply too little. And if you look at the recent ECF cases, the valuation is just absurd. They are more expensive than some of the listed company kind of valuation. So is that worth it? I think it's quite a subjective question. There are also potentially good projects, but again, comes down to whether you want to take up the risk or not, right? Now, some of the seasoned investors here, they might already know how warrant works. But again, for those who do not know, warrant is one of the things that I would prefer to highlight today. Now, again, warrants, they are considered quite a leveraged product for advanced investors to invest or to trade or to hedge. There are a lot of things that you need to understand about warrant before you should touch it. But generally speaking, there are two types of warrants that you need to remember, as shown in the graph. The first one being the call warrant. So call warrant, what does that mean? Very simple. Imagine that you're putting out your phone, you're trying to call someone. So it's on an up motion. When you are buying a call warrant, you would hope that the underlying asset, because warrant is based on something, is whether based on a security, based on index, based on a stock. You buying a call warrant of something, you hope that it will go up. And a put warrant, it's like you're putting down a phone, it's a down motion. So that would mean that you hope the price of the underlying securities to go down, right? So we go into a bit of technical items in warrant itself. So first of all, we have exercise price. What do you mean by exercise price? So I mentioned that you hope the share price to go up. Why? This is because warrant give you the right but not obligation to execute the contract. So let me give you an example. If you buy call warrant A of ABC Berhad, today ABC Berhad is trading at 7 ringgit, and the call warrant allows you to buy ABC Berhad at 5 ringgit. So would you buy the warrant and then convert it into and then sell it at 7 ringgit? Of course you would do it because there's an arbitrage opportunity there, obviously. So when there's an arbitrage opportunity, there is a value to the warrant itself. So imagine that some of the warrants, they actually have a gearing ratio. That means that, okay, if the underlying asset moved by 1 times, probably the warrant price will move by 2 times because there's a leveraging effect onto it, right? And but there's a drawback to it. It's not that this kind of warrants, they are on perpetual basis. There is a expiry date. And there are a lot of investment banks in Malaysia that actually offers you a calendar, but not per se calendar, but and a tool for you. What they call is life metrics, and for you to measure. Okay, let's say the expiry is 6 months from now. So what would happen to the price of that warrant if it's closer to the 6 months period? Okay, well, why is this important? So the function of warrant, again, it gives you the right but not obligation for you to execute, is that you can choose not to execute. But the longer the time period, the higher the chance for a share price to go up or down, right? There is more room for fluctuation in between that. So this is what we call premium or time value of money to warrant. So I don't think I have time to, truly break it out the warrant fully, but I hope you get the rough idea. It's something for you to leverage on it, to actually to utilize on it, so that you could, even though you don't own the securities itself. Let's say if index, Malaysia, one of the hottest warrant that you always see is the Hang Seng Index. So it's a Hong Kong index, and we as retail investors, sometimes we do not know how do we get exposure to the movement of Hong Kong market. So through warrants, you can do it. So let's say back to portfolio level, why is this important? If you are building a portfolio that is generating you cash flow, but at the same time, you are seasoned enough to feel that the market is not right, well, the companies are overvalued, things like that, and you think that market is going to crash. So you can have a put warrant. Again, put warrant is you're hoping for it to, to go something you hope. So put warrant, you will buy put warrant to hedge again your portfolio. So just in case the market crash, you can sell the put warrant because you could earn money from there, obviously, because the Hang Seng, let's say Hang Seng Index, for example, went down. The put warrant, the value of put warrant increases. So at that period of time, you can sell a put warrant and you can have the cash to buy the depressed shape, the price valuation of the securities that you're interested. So that's one thing that people will use it to hedge against the market, right? So back to question number 1. Is warrant good instrument to put into your portfolio? Again, I would say that depends on your risk profile and how well do you understand the warrant itself. Most importantly, always look at the time value of money of warrant. Always look at it, because warrant is never an instrument for you to hold over long term. It's meant for you to trade. Okay. As the time getting shorter and shorter towards expiry. By the way, once it expires, you get if it's what we call in the money, you get something back. But it's on the money or out of the money, you get nothing at all. So when the period gets shorter and shorter, obviously the opportunity for fluctuation reduces. So does the premium of that warrant. So if you hold for a long time, if you do not look at it, and you're not lucky enough to move in the correct direction that you are looking for, and your warrant could burn to nothing. You could have a 100% loss from it. So be really careful with warrants, right? So for beginner itself, I really would recommend you start looking into it, looking into ETF, looking into bond funds, and perhaps even into some of the interesting stocks in Malaysia, like some of the banks and real estate investment trusts, REITs. That one I don't have space to put in here, but REITs is like you buying the asset and then you getting the you buy an asset and then you assign someone to manage it for you, and the rental that the manager collected, it will translate into dividend to pay back to you. So these are some of the good starting point for investors to look at. But if you are at an advanced investor and you want something more exciting, more challenging, probably ECF and probably warrant is more interesting for a portfolio. So ultimately, I do not have a set of fixed equation for you to just plug and play. Then I know exactly how much do I need, but it's up to you to actually sit down to figure out, okay, 10, 20 years from now, if I were to stop working, what kind of home do I wish to stay at? Realistically. So what kind of house do I dream on staying on? What kind of car do I hope to drive? And what kind of things that I really want in life? So really think about that and make sure you calculate the amount of passive income you will require to hit that goal. Again, you need a reverse calculation and figure out the initial capital that you need, and also what kind of rate of return that you need to get. So obviously, going back to bond, you normally don't expect a high single-digit return from it. We're talking about MGS is probably 5 to 6%, and we're talking about maybe even Maybank. If you don't talk about capital appreciation, which there rarely are capital appreciation for FPM-KLCS stocks nowadays. You're looking at the dividend of 6 or something percent. You do a reverse calculation, see how much of a capital you need. Then, based on your active income, let's say you earn 5,000 per month and 1 year is 60,000, then you start calculating, let's say if I can save 10% every year, how long do I need to hit, let's say 1.2 million? Obviously, it's a very long journey. So you cannot just rely on your active income to build a portfolio. You will need things like maybe ETF, you reinvest the dividend or the capital gain, or ECF, something go big. You're lucky enough to have something go big. It will change your life forever. Or you're an expert that you know how I use warrants to leverage, to enhance my return along the way, right? So really sit down and try to figure out how much money, how much of a risk can you take in for building your very own portfolio, right? So I think that's all for my one-way car sharing. Look forward to have a Q&A session with every one of you so that we can have an interesting conversation ahead.
All right, thank you so much, Max, for sharing with us how do we build a sustainable portfolio. So if you have any question to ask our speaker today, you may write them in the Q&A box, so we'll address them accordingly. Don't write that in the chat box here, write that in the Q&A box so we can manage your questions better. Max, I think just now you talk about structured warrants, right? So the first question by Hui Yi is that what happens if the issuer doesn't queue at the bid and ask price? Where can I sell my put and call warrants?
Okay, thank you for the interesting question. I think generally in Malaysia, there is the issuer. Let's talk about some issuer that are more established, Kenanga and Macquarie and probably RHB. They have a mechanism, what we call market making. So what does market making means? Once they have the metrics available, let's say tracking into Hang Seng Index, they will follow closely to that index itself. Let's say if Hang Seng move up by 10 points, so what will happen to the warrant price? So they will have the market maker to queue at the bid and ask accordingly. But obviously, when Hang Seng is, I think Hang Seng is opening half an hour later than us. So at 9 a.m. to 9:30 a.m., there will be no market maker. So if you are referring to that period of time, how do you actually sell your call and put warrant? You can still sell. For example, today I'm selling at Hang Seng warrant, put warrant B. I'm selling in the market at 10 cents. Then Shane saw the Hang Seng warrant being sold at 10 cents. He can actually buy from it directly. Not necessarily from market maker itself, but you can buy from other people. But again, when you buy from other people, there's no market making, there's no effective market making mechanism in place. So maybe the warrant I sold is actually worth 30 cents. But because no one is buying, I'm forced to sell at 10 cents. There will be a huge spread between bid and ask if the market making mechanism is not in place. So be really careful with that, especially in non-operating hours of the market making. So be really careful. Try not to, if possible, try not to force yourself to sell during that non-market making hour. So it will cost you quite a lot. Or you want to buy at a premium. Let's say at the period of the time, there's something called SOA warrant. So what does that mean? If warrant is just like stocks, they need to issue a term sheet. What is the maximum number of circulation of warrants available in the market? So there's an incident back in 2020 where 1 million plus units of warrant completely taken up by market. So but the market maker, he or she will require a certain control of supply and demand. He need money to buy from you, but at the same time, he or she also need the number of shares of warrant to sell it back to you to maintain a fair bid and ask. Imagine that the supply has gone. Everyone from the market has taken up all the supply. So there is only the bid left. They can only queue at the bid. But because the demand is so huge, there could be huge premium that occurs in the market. So if you want to buy it, it will be not from the market maker itself, probably from me or from Shane. Then we can increase the premium. We can set our price because we know that market maker is not effective anymore. So when you're buying into structured warrant that issued by investment bank, make sure you follow their social media. They would announce that, let's say Hang Seng warrant H3X, it's already in sold out status. So they will warn you and be really careful not to overpay for a warrant. So these are the scenario that would happen, where do not have a proper bid and ask price.
Yep. So aside from that, there will always be a bid and ask price. If you observe that the bid and ask price are not following what they share with you via their live matrix, then you can also complain. You can write into them, try to ask for an explanation why this warrant price don't move according to the live matrix that you have published. So you can lodge and complain with them. All right. So basically all structured warrants issuer will market make the products, but not all market makers will publish their live matrix. So it depends on whether they publish a live matrix. Okay. So if your underlying is not based in Malaysia, then there will be a period where they don't have market making because the stock market is either not open or already closed. But if your underlying is in Malaysia, is listed on Bursa Malaysia, then it is definitely that it will be market makers that are queuing at a bid and ask, unless that the warrant has been sold out. That's what Max wanted to say. All right, let's clarify. The next question is asked by Fu. When we buy an ETF listed on Bursa Malaysia that hold foreign stocks, then when Malaysian ringgit depreciate, will the exchange traded fund price go up the price in the forex rate?
Okay, I think that's a very, very interesting question. So let's say we have an ETF that, let's say we have 30 basket of stocks and maybe 10 of them are in US dollar. I think let's refer it to US dollar. It will be easier for everyone to understand. So ultimately, how do ETF, they define their price is based on NAV, net asset value. And imagine that by end of day, when they calculate the net asset value of that security, let's say it's a US stock, and by the time Malaysian ringgit depreciated, so your holdings in US dollar will effectively increase and your NAV will increase on that basis. But it comes down to the term sheet of that ETF, whether the changes of foreign exchange will be reflected on daily basis, on monthly basis. I think it's best that you check with the issuer itself. When would it be reflected in the NAV? I think probably when you ask this question, you are looking forward to, probably have some arbitrage opportunity. Knowing that today US dollar is very strong, then NAV will reflect in NAV. Then we start attract some investors because there's a discount to NAV in terms of the trading value. But I think it's best that you check with the issuer itself what is the policy for them to renew, to check on the foreign NAV as reflected to the overall group level NAV, not group level, sorry, ETF level NAV. It's best for you to check with the issuer.
Right. Thank you so much, Max. I think there are also some ETF that are quoted in US dollar and traded in US dollar. The next question is by Gore. How can you evaluate the performance of startups if they do not have a history of performance? So what happens if their products are not successful? Will the investment be burned?
Okay, I think when you are evaluating the performance of startup, like what you say, you cannot evaluate because they do not have a history, obviously. So what can you do? What you can do is probably to look at the founder's profile. So let's say, I give you an example, two companies are, both companies are saying that, okay, we're gonna do a technology startup. Okay, one group of people, they are young people, and they are very passionate. They just graduated. Probably some of them have experience in an MNC. Okay, so this group of people, they have a very good vision, very passionate on it, and they have a very comprehensive plan, right? But they do not have a history of performance. And another group of people, these are people that comes out from, let's say, Facebook. These are people that actually comes out from Grab. So they do not have a history, but when they show you the founder profile, immediately you will have confidence in them because they have been involved in this kind of big companies before. So it's the easiest way to evaluate a startup is to pre-seed or maybe seed round is to evaluate their the founder's profile and their plan, whether it makes sense to you or not. If the plan itself doesn't make sense, probably it's not good for you to invest. And if the product or their launch of the startup is not successful, in the case of ECF, in the case of ECF, or maybe into your private investment, your triple F investment into the private companies, yes, the investment can be burned and can be completely into nothing. But normally ECF, we still have some protective mechanism, which is the redemption. At least the company, they still would have some spare cash to redeem back the shares from you at a certain valuation. And plus, a lot of ECF nowadays, they give you a 6% to 12% kind of dividend per year, and they give you a lot of benefit along the way. So it's not total loss. You still can recoup some of the losses along the way. So yeah, if that's what you're asking.
All right, thank you so much, Max. The next question is by Lim. How do we buy bonds such as MGS?
Right. So if you want to buy MGS bonds directly, I think the block size, I think it's around 100,000 or 250,000. I couldn't remember the exact size. I think it's 100,000, somewhere around there. But if you want to buy MGS at a retail level like me, you can go through unit trust or you can go through mutual fund. You can go through the bond funds, right? Because MGS, they are quite large in size itself. So I think the easiest ways for us to approach is probably go through the mutual fund or unit trust.
Okay. The next question is by Lim also. How do we use L&I ETF on our portfolio?
Okay. I think L&I ETF, there are a lot of ways that you could incorporate into a portfolio. So maybe talk about the leverage first. So imagine that we talk about why do we need ETF in our portfolio, right? One is to get exposure to foreign shares. Two is that you can be benefited from the foreign exchange. Now, leverage ETF in Malaysia, let's say products by Trade Plus, which is Affin Hwang, and I think Kenanga, they also have a similar product, similar ETF products as well. So it's called One Trade or something. Sorry, couldn't remember. But this kind of products would give you the exposure to one, to leverage the direction that you are hoping for. Let's say FBM KLCI, you don't want exposure to foreign, fine, but you want to get exposure to FBM KLCI, but you don't want warrants because the risk is much higher, gearing is much more higher, and there's a time value of money. So you opted in for ETF instead. But bear in mind, L&I ETF, they also have a mechanism that they reset every day. It's not as straightforward as if it goes up 10% over 10 days, your ETF will go up by 10%. It doesn't work that way. It's refreshed on daily basis. So it's daily rested. So if it goes zigzag along the way, you might have losses along the way, even it goes up ultimately. So be very careful on the daily rested calculation. So back to incorporating into your portfolio, I would generally say if you ask me about an ETF, I would want them for one foreign exposure, and some of them like Hang Seng, or maybe we're talking about in maybe Golden Dragon Index, maybe the Nasdaq. I would next want exposure to these kind of platforms because not necessarily we can get exposure in Bursa towards the foreign share market. So I will use a leverage tool to enhance my portfolio if I'm really positive or really bullish towards that market. And inverse portfolio, inverse ETF. This is something that you could do hedging, or it's a direction that you predict the market will go. Let me give you an example. Like if you are investing, you are having a portfolio. Let's say 80% of your money has invested into bonds, stocks, and maybe ECF, partial of it, and 20% you have left cash, and you think that the market is crashing. It's just like the warrant case. So what can you do? You can buy inverse ETF, and you can look at the underlying asset they are tracking or underlying index they're tracking. So if you have a bad feeling about the market, again, please remember it's always daily rested. Even if indefinitely it went down, if daily rested, you might still end up losing money. So it's more suitable for trading for the NI ETF. But anyway, if you have the gut feeling or something you want to do hedging towards it, you can always go for the inverse ETF. For example, in FPM KSCI, or maybe towards the Nasdaq index, maybe on Hang Seng, whatever it is. It has a bit similarity towards the the warrant in that sense, but there are more extended portfolio in the basket for the ETF itself.
All right, thank you so much, Max. To clarify, it's not every retail investor can trade LNI ETF. You need to pass the criteria. There are about 4 to 5 criteria for you to meet. If you just meet one of them, then I think you'll be eligible to trade the ETF. LNI ETF. Yep.
Yeah, thanks for reminding, Shane. I think you can take an examination that is available for everyone on Bursa Marketplace. It's I think 1 hour or 2 hour. You need to go through the videos, and then you need to take a very simple exam, and then you will get a certificate, and probably you can submit to your remiser or dealer. Then your account will be subjected to trade LNI ETFs. It's relatively simple and it's free. So recommend everyone to go and try it out on Bursa Marketplace.
Yeah, that's Bursa Academy.
Bursa Academy.
On Bursa Academy, yes. Very simple. You just need to make sure that you have the knowledge. Then you take the test. Then when you pass, then it's fine. You'll be able to you'll be eligible to trade leverage and inverse ETF. The next question is about, as a small retail investor, how do we build our small portfolio to about 6 to 7 figures? Do you have any idea?
Okay. Quick disclaimer first. This might work for. This is based on my personal experience. It might not work for other people. How do I build up the portfolio to that size? Is I concentrate a lot on equities, number 1, which give me a higher upside, of course, up and downside. And number 2, my portfolio, when I'm anything lesser than 100,000, I wouldn't go for anything more than 5 stocks, unless it's for trading position. I only focus on a couple of stocks that would give me, when it goes up, the whole portfolio value goes up. Let me give you an example. If you have 100,000, let's say if you have 10,000, but you're buying into 10 stocks. So one of the stocks actually went up by 100%. So how much does your portfolio overall go up? It's only 10% in portfolio level because you diverse too much. Okay, but if you only have 5 stocks for the same case, okay, let's say a stock went up by 100%, your overall portfolio will went up by 20%. That is your overall wealth. So concentration level below 6 figure, I think it's very important that you do not have too much of the stocks along the way. But ultimately, that is on my personal view. I know that it is also risky, on concentration. That is why on the risk management part, I emphasize that there are a lot of aspects of risk that you need to look into. It's not only understanding how much money you can lose, but understanding your investment. How well do you understand let's say stock itself, which is the I think a very good chance of winning as compared to other securities, if you ask me. As long as you understand the company well enough, understand the growth landscape of the company well enough, I think it's pretty good for you to leverage on it. So concentration is key when your portfolio is lesser than six figure. I think that's how us as normal people can actually build up our wealth.
Okay, when you mean concentration, do you mean that retail investor can also focus, like all in technology sectors, like 5 stocks, 6 stocks, all in technology sectors? What do you think?
Okay, interesting
High
question.
growth stocks.
Okay, it depends on your risk profiling. I think if you're in the right time, of course that would work for you. But imagine if you all into technology stock starting from 2022, your portfolio would suffer badly at the moment. So even though we're talking about concentration, it's always remember to go back into ground one. Never buy into extended valuation. I think we discussed that in our previous webinar. With Shane. Never buy into extended valuation, no matter what time it is. Never buy into extended valuation, especially you are having a high concentration kind of risk. So look for companies that you think will grow tremendously. If the valuation is too high and is absurd, maybe like 70 to 100 times PE, just wait. The opportunity will always come. You just don't know when. It will always come on. So especially if you want to concentrate that money. Imagine you're buying into 70 times PE, the market is expecting the company to grow at 70%. So very likely than not, the company will disappoint the market with 70% growth. Like I think Peter Lim had a book, very well explained that it's easier to disappoint than to impress. So let's say the company delivers 70% growth. So what? It's in the expectation of the market. The share price might even drop. But if the P is 30, the company deliver a subpar, let's say 50% growth, it will still surprise the market. So never buy into extended valuation of stocks, especially you are focusing into it. And if you're talking about a full technology portfolio, I think that's still possible, but provided that you are coming from a engineering or maybe technology kind of background. So you understand the landscape very clearly, that what is actually going on, and not just purely chasing after the hot topic of the market, which is technology. So I think, again, back to the risk, how well do you understand your investment? That is also critical.
Yeah, I think the past 2 years has taught retail investors about valuation re-rating for the technology counters.
I myself, I suffer from it also. There's a stock I invested to. I think that stock, I give you guys a hint. It's the highest profit margin company. Once the highest profit margin company in Malaysia, and the valuation is around 70, 80 times. So overextended valuation, but the prospect is very bright. But when the market turned down, they couldn't deliver. The immediate, like Shane said, immediate re-rating of the company, then you will suffer. Especially you have a focused portfolio that you aim to build into 6-7 figure portfolio, you suffer a lot from it.
Okay, so would you recommend like small account size investor to use leverage to reach 6 to 7 figure?
No,
much
no.
faster. Structured warrants.
If you're talking about structured product, then maybe yes. If you're talking about using margin to borrow money just to invest, then I would not recommend it, because first thing, when you're starting into building a portfolio, that means that you are still building your portfolio. So you are building your experience as well. So unless you are a very seasoned and experienced investor, so I never would recommend leveraging. And unless it's a leverage product, then your loss are kept. Then if you're having a margin, the worst case, your margin call, you can still owe the IB money. So that one is the worst case scenario. So for starter, I would say that the most important thing is to gather to figure out your investment style, to figure out what kind of risk appetite that you can take, to understand what kind of investor you are, rather than to take on it to leverage risk immediately.
All right. So looks like we are running out of time for the question and answer session with Max. So thank you everybody for participating. So thank you so much, Max, for doing this segment for us.
Right. Thank you, everyone. Thank you, Shane. And I hope you guys have a great long weekend ahead. See you guys again.
All right. So as what we have mentioned just now, Bursa Academy. Bursa Academy is a place for you to get eligibility to trade LNI ETF. So Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey. On Bursa Academy, there are a lot of investing resources for you to access, be it investment quiz, investment article, investment coursework, for you to access. Just head over to www.bursaacademy.bursamarketplace.com or scan the QR code here to access Bursa Academy. So our next webinar is titled Kepentingan Elliott Wave dalam menangkap peluang super bull. So like the title suggests, it's going to be held in BM. So it's happening on the 3rd of July, it's Monday, 8:30 to 10 p.m. So here is the registration link for you to register for the next webinar. So you want to learn how do you use Elliott Wave technique to catch a super bull, opportunity, join us in this session where we're going to share with you how do you do that. All right, so I've just given you the registration link in the chat box. So with that, I want to thank all of you here for staying here until the end of this webinar. So hope to see you all in our next webinar. So bye everybody. Have a great weekend.